You move £5,000 from one account to another just to tidy things up. An hour later, the phone rings and your stomach drops before you even answer. Was that transfer fine, or have you just done something that looks odd? That small, cold feeling is exactly what far too many decent people are living with now. If you like calm, straight answers without the usual waffle, subscribe and keep a seat here for yourself. This channel is for ordinary people who want to stay safe, not clever people who want to sound clever. Because today we need to talk about the way money moves between bank accounts and why old casual habits can cause real trouble. Not because every transfer is wrong, but because the system notices patterns and boring paperwork matters more than ever. The theme all the way through this is simple. A clean money trail beats a clever money move every single time. I want to walk you through 7 very common ways people over 55 still move money that can bring questions from banks, letters from HMRC, our tax office, or worse, a scammer into the story. And the rule you can carry through the whole video is this: if you cannot explain the journey of the money in one calm minute, do not move it that way. The first mistake is treating your own bank accounts as if the trail does not matter because the money still belongs to you. That usually starts with something innocent enough. You move savings from one bank to another for a better rate, then into a joint account for a bill, then back out again because you changed your mind. A week later, you can barely remember what moved where, never mind why. Now, moving your own money between your own accounts is not, by itself, a taxable event. The trouble starts when the pattern looks messy and the story behind it is unclear. Banks already monitor unusual behavior for fraud and money laundering checks, and HMRC receives annual information about bank interest and can ask financial institutions for information when it needs to check a tax position. So the risk is not that one normal transfer is forbidden, but that a muddled trail makes a decent person look harder to understand. The phrase to write down is this: same money, same owner, same reason. If the money is yours, keep it in your own name where possible, keep the transfer reference plain, and keep one simple note saying what the move was for. That note can be as simple as moved from Bank A to Bank B for better savings rate on June 12th. If that sort of practical calm is useful to you, do subscribe, because this channel is really about helping you stay one step ahead without losing sleep. The second mistake is one I still hear whispered like old folk wisdom. Do not move the whole amount at once. Break it up. Keep it under the radar. Please stop doing that. There is no magic safe number that suddenly makes a suspicious transfer innocent, and splitting money into smaller chunks can look worse, not better. This especially matters with cash. If you have been keeping notes at home, or you sell something privately, or you have years of small cash savings, the worst thing you can do is drip feed it into the bank in a pattern designed to avoid attention. That can look like someone trying to stay below a line, even when there is no criminal intent at all. And once a bank thinks a pattern itself is the problem, the fact that you meant no harm may not save you from delays, questions, or account restrictions. The relief phrase here is one honest amount with one honest explanation. If the source is sound, the size is not the real issue. Bring the paperwork if there is any, say clearly where the money came from, and do not play little games with timing or round sums. The system is far more comfortable with a large transfer that makes sense than with 6 smaller ones that look as though they were designed to dodge notice. The third mistake is using somebody else's account as a stepping stone. A daughter says, "Send it to me first and I'll move it on." A friend offers to hold the money for a few days while a new savings account is opening. A partner says, "Just run it through my account because my app is easier." That sort of thing feels helpful in a family, but on paper it can make the ownership of the money look blurred. And once ownership looks blurred, several kinds of trouble can turn up at once. A bank may wonder why money is arriving and leaving without a clear reason. HMRC may later ask whether a payment was a gift, a loan, undeclared income, or proceeds from something else. In the worst cases, ordinary people can even be pulled into what looks like money mule behavior, which is simply when one person's account is used to move money for somebody else. Your phrase for this one is, never borrow another person's trail. If the money is yours, let the path stay yours from start to finish, unless a solicitor, executor, or other proper professional structure is involved. If there really is a loan or a family arrangement, write it down at the time, not 6 months later when everybody's memory has gone soft around the edges. And if you value plain English protection like that, you might want to subscribe now, because small habits are what keep bigger problems away. The fourth mistake is rushing large one-off sums because they feel like good news. A pension lump sum comes in, house sale money lands, an inheritance arrives, and suddenly a perfectly sensible person turns into a panicked air traffic controller, waving money from bank to bank, trying to get the best rate before tea time. Let me give you a real sort of story, even though the name is changed. Margaret is 67, newly widowed, careful by nature, and not at all reckless. She sold the old family home, took some money from her pension, and wanted everything spread safely across different banks. By the end of one stressful fortnight, she had moved money through a joint account, into an old current account, out to a new saver, and then back again after a fraud warning froze one transfer. Nothing Margaret did was wicked, but the trail became harder than it needed to be. Remember, up to 25% of a pension pot can usually be taken tax-free, but the rest of a large withdrawal may still affect your tax position. If a main home qualifies as your main residence, you will often have no capital gains tax to pay on the sale, but not every property sale is automatically tax-free, and some gains on UK residential property must be reported quickly. So when money arrives from a pension, a property, or an estate, you need the source papers to travel with the money in your own records. The named relief for this is a source pack. That just means one folder, paper or digital, holding the pension statement, solicitor completion statement, estate letter, and a short note saying where each amount was sent next. Margaret did finally get herself sorted, but what calmed everything down was not a better interest rate. It was one tidy folder and one clean story, and if you want more of that kind of steady thinking in your week, subscribe and stay close to the channel. The fifth mistake is muddling up gifts, help, and shared family money. A son needs a hand with rent. A granddaughter is getting married. A brother asks you to hold some money for a few months. These things happen in ordinary families all the time, and they often begin with kindness rather than planning. But kindness still needs paperwork. In the UK, gifts can matter for inheritance tax, which is the tax that can apply to part of an estate after death. There is the well-known 7-year rule, there is an annual gift allowance, and there are special rules for regular gifts out of income. But none of that helps much later if nobody can show what the payment was meant to be. If a transfer was a gift, say it was a gift, record the date, the amount, and who received it. This is why I often say that a family transfer should never be left to family memory. Write a simple note that says gift, loan, or shared bill contribution, and if it is a loan, add how and when it should be repaid. That one sheet of paper can spare a great deal of confusion for children, executors, and even HMRC later on. And if there is someone in your life who always says, "We'll remember what that was for," they probably need this message even more than they realize. The sixth mistake is hopping money in and out of savings wrappers without checking the rules. This catches very sensible people because it looks so harmless. You take cash out of one savings account or an ISA, which is an individual savings account, to chase a better deal somewhere else. Then you try to put it back or move it again, and only afterwards realize the rules were not as loose as you assumed. With an ISA, the detail matters. Some are flexible and some are not. If you take money out and pay it back in yourself, you can affect how much of your yearly allowance is left. And if you want to move an ISA between providers, the proper transfer route matters more than people think. On top of that, once you start spreading savings widely, interest outside tax-free wrappers can affect your tax code because banks report interest information to HMRC each year. So the phrase here is, do not withdraw first and ask later. Before moving money, ask the provider one direct question. Is this a withdrawal, or should this be done as a transfer? And if you are chasing savings rates across several banks, keep a running note of expected interest so there is no nasty surprise if your tax code changes later. If you enjoy having somebody translate this sort of thing into normal human language, do consider subscribing, because that is exactly what this channel is for. The seventh mistake is the most dangerous of all, because it does not begin with your decision. It begins with pressure. A text says, your account is at risk. A caller says they are from the bank fraud team. An email says HMRC owes you a refund, or you must act now over a penalty. Then somebody tells you to move the money to a safe account. There is no safe account run by a scammer, and there is no honest caller who needs you to move your money in a rush while staying on the phone. HMRC says it will not send you a text, email, or app message telling you about a rebate or penalty and asking for personal or payment details, and the regulator warns that bank transfer fraud happens when people are tricked into sending money willingly. So the most dangerous transfer can look like the most urgent and responsible thing you have ever done. Your phrase for this one is, stop the journey before the money starts. Hang up. Use the number on the back of your card or your bank statement. Speak to a real person using a number you found yourself, not one given to you in the message. And if this sort of calm interruption feels valuable, maybe subscribe, because sometimes the safest financial move is simply refusing to be hurried. Now let me pull all 7 of these together because the pattern underneath them is what really matters. The bad move is rarely just sending money. The bad move is sending money without a clean story, under pressure, with poor notes through the wrong route, or with the mistaken belief that small chunks are somehow invisible. That is why the central theme matters so much. A clean money trail beats a clever money move every single time. If you are 55 or over, this becomes even more important because life gets more lumpy. It is not just wages coming in and groceries going out anymore. It is pension decisions, house sales, helping children, dealing with bereavement, moving savings around, and trying to stay one step ahead of fraud. In other words, the amounts get bigger, the reasons get more personal, and the paperwork suddenly matters in a much more serious way. So here is the practical ritual I would use from today onwards. Before any transfer that is larger than your normal monthly life, stop for 5 quiet minutes. Ask yourself whose money this is, why it is moving, whether the route stays in the right name, what proof exists for the source, and whether a stranger has added any urgency. If you cannot answer those 5 things calmly, the transfer waits until you can. Then keep one running money trail file, not 10 folders, not a drawer of loose envelopes. Just one place where you keep bank confirmations, savings screenshots, gift notes, pension letters, property statements, and a short explanation in plain English. You are not building a case for court, you are building a calm memory for your future self. That matters more than people think, because confusion is expensive. It leads to missed tax points, lost allowances, family arguments, frozen transactions, and scam losses that started with somebody sounding helpful. Clarity, by contrast, is wonderfully boring. It lets you answer a bank query in 2 minutes, explain a gift to your children in 1 sentence, and sleep at night without that nagging feeling that something may come back later. And near the end, let me say one gentle thing. If you know a parent, neighbor, brother, sister, or old friend who still moves money by instinct and hope, send this video to them. Not to frighten them, just as a quiet kindness, because so many honest people are getting caught not by greed, but by ordinary confusion in a world that has become much stricter and much faster. The picture I want to leave you with is a simple garden path, not a maze, not a secret tunnel, just a clear path from the back door to the gate, with each stone laid in order so you can see exactly where you have stepped. That is what your money trail should look like now. When money moves cleanly, your mind stays cleaner too. You do not need clever tricks. You need a straight path, a few good notes, and the confidence to slow down when something feels off. That is how ordinary people protect themselves now, and there is real dignity in that.